Welcome to the Dividend Talk podcast, episode 189. How we maintain our dividend portfolio and why. Dividend Talk is your number one podcast for all things dividend and stock market related with a unique European flavour. My name is Derek from Engineer My Freedom, and I'm joined with my co-host, European DGI. If you want to learn more about us, please visit europeandgi.com, where we have articles on dividend growth investing, including 30 European dividend aristocrats. While you're there, you might as well grab our free dividend portfolio tracker template. We also offer a premium dividend growth service featuring a bi-weekly newsletter, which includes stock deep dives, dividend stock cards, and access to our dashboard with over 130 dividend growth stocks. All of this is based on our very own dividend safety analysis. But enough about that. Please grab a cup of coffee and let's get started. Yo, European DJ. Long time no speak.
Yeah, life goes quick, right? When you're having fun. I was on a vacation break, going to Italy to the Dolomites, nice skiing. So I really enjoyed it. And as you can hear now in my voice, I brought a cold with me home. So I have to hang out here this next hour because I'm sneezing a lot. But I'll try to mute when I'm doing that.
Yeah, so all that sunshine and pasta is upset your body, has it?
Yeah, well, it's worth having it. Let's say if that was the price to pay for it, I'm all for it. It was awesome. I mean, to all my Italian listeners here, right, guys, the Dolomites are awesome, and skiing in March there is awesome. Still full packed with snow. The tracks are really well prepared. Also, the service is really good. I was surprised because Italians are not necessarily known for the best service. But in this area, it was really, really good service, both at the hotel but also at the ski tracks. I was very much impressed with that. It's not just pure business. There's also the human element in there, which I enjoyed a lot. So that was really nice, really, really good to see. Something positive, right, for Italy, because often we hear the complaints about the economy and this and that. But I was very positive surprised about it.
Yeah, I like it. I go there quite a lot, but it's mainly business travel. But obviously, you get some free time in the evenings, and I think the service is always good there. It was really hot when I was there. I was probably there a similar time to you, and I could see in the distance. So we're in northern Italy as well, Bologna. You can see in the distance the snow on the mountains, and I was thinking of you up there.
Yeah, I was probably there.
You were probably there. I was enjoying the sunshine, so we were both happy. So.
Yeah, definitely.
But hey, a lot has happened in the 2 or 3 weeks since we spoke. We were supposed to have a show last Sunday. Apologies to our listeners. I know we got a lot of messages from our running crew that they had to run to a different podcast. It was, again, unfortunate we couldn't get together. But what's happening in the news? What's
well, let's stay into the cold climate topic, because Unilever decided to sell their ice cream branch, which is very, very interesting. So what the board is saying here is that, in their opinion, ice cream has a very different operating model. So that's why they decided to sell it. I remember when I was listening to the podcast with Hein Schumacher in December, this fire chat talk that they had.
Yeah,
that he was mentioning about, the ice cream business. If you look where the competition comes from, it's local ice cream shops that make their ice handmade and this all fabricated. So they really need to reinvent and then redesign the entire supply chain so that they can also give this kind of ice cream experience. And seemingly he has thought a lot about it. Because for me it's a little bit sad as a Unilever shareholder, because they have delivered almost 8 billion in 2023 in revenue. Yeah, they have 5 of the top 10 selling global ice cream brands. Why can't they get more out of this? And The main thing that they've been doing is shrinkflation. Yeah, the Magnum ice cream shrunk. I mean, what are they going to do now? Spin it off, and then the others need to deal with the size of the Magnum. I I understand that they're looking at it from a capital allocation point of view. What they say is like this business is also very capital intensive. They also expect that the demerger of the ice cream will effectively increase the margins of Unilever. So seemingly it's a lower margin business. I don't have that feeling when I pay for the ice cream. Yeah, it feels like premium pricing, but seemingly the costs are also very high. So yeah, now we start to see the first actions of the CEO, supported by, of course, the active investor. And yeah, I'm worried a little bit if this is really the right path of selling your crown jewels. That's how it feels a little bit. But we don't have a good insight in the margins of those businesses and the profitability. So look, the separation will start directly. It's expected to be finished by 2025, and it is yet to be seen whether it will be listed as a new company or whether it will be just sold to another company or maybe a private equity investor.
Yeah, I can't say I'm really surprised if I'm honest. I remember way back when the ice cream branch had their own little, I don't know, did they get a slap on the wrist for being outspoken at the time about Israel, if I remember
Yes,
correctly.
yes, yes.
And it seems both boards, because we know that the board separately have been at odds with each other ever since. And
Yeah,
I think at that time we wondered if a spin-off was inevitable,
yeah,
would it happen? And look, it looks like it is happening. I agree with you on shrinkflation. I mean, for me personally, as a consumer, I prefer local brands because you get more bang for your buck. I buy a Magnum now; it's
yeah,
tiny. I
yeah, yeah,
remember,
yeah,
I remember getting Magnums. It was always huge. It was luxury. It made you feel like
yeah.
it was worth paying for. Now I don't get
It
that
isn't
same feeling.
anymore, right? Yeah.
Yeah,
But I think this is the issue of the company of just years and years not being really into product innovation,
yeah,
but just like treating it as a product in a saturated market at the end of the life and then squeeze the last bit out of it. But cost savings is always the easy way out in the short term, but it hurts you in the long term, and
mm,
that's very very much I think the case here. um yeah, let's see where it goes to, right? And,
yeah,
and what you mentioned, like having your subsidiary suing you for its take position on Israel and Palestine, that's not a healthy relation. So I can also imagine that they will miss Ben and Jerry's like a good old toothache.
But I wonder, will they use this opportunity for a stealth dividend cut?
I think so. Yeah,
Yeah,
I think
so,
so. I think they will use this. I don't. We saw already that the dividend policy changed, right?
yeah.
They don't articulate a sustainable dividend anymore, like and a growing, let's say. So I just think like that they will cut the dividend at least pro ratio, and maybe they will call then a competitive dividend, a competitive, attractive dividend.
Sustainable dividend.
Yeah,
Yeah,
yeah, it's,
I think so. Look, when I saw that, it was the first thing that came to my mind was the change in that policy. The timing of that change in policy coincides with this. It feels like it's a perfect opportunity for the CEO. He's not breaking any rules. He's going to look at what he said and go,
yeah.
I'm carrying out on what I'm saying. So for me, it looks like they will do that. So
This
let's
is a really tricky situation for us as dividend growth investors because the dividend has been flat for a while. The
yes,
dividend safety decreased with current management actions. So are we then going to see it as a turnaround story? Because that's the issue, right? You see now that the CEO is taking action, and we know that in this company, a lot of value is to be realized. We
yes,
know what what's the guy again? The hedge fund investor, the activist investor, Nelson Peltz,
Nelson
what he
Peltz.
has done with P&G. Yeah, it was really a growth story after that. Yeah, but is it worth to treat it as a turnaround in the light of a potential dividend cut? Right. I know we're speculating here, but it's quite a mindfuck for us as dividend growth investors.
it's it's a difficult one to say, but look, what I have to say is when I sat down and looked at Unilever 3 years ago, my thesis was a lot different than what it is now, and it's pretty much why I sold it. That it's hard for me to envisage where this growth is coming from. I can see I can see the CEOs trying to make some waves. He's trying to take some action. He speaks very well, but I don't know if that aligns with what I'm what I want.
Yeah,
And
yeah.
seeing something like this, even the detail of changing that dividend policy, for me, it just seems like he's going he's going to go down a road that I don't fully agree with, but it might unlock future potential. In 5, 10 years' time, investors might be well better off. But
Yeah.
in terms of my thesis, it didn't match. So
So then it really becomes a question of opportunity costs, right?
yes, exactly. Exactly. What about Apple? Apple are in the news again, and this time another lawsuit for another American company.
Yeah, very interesting. And we got also two questions about this from Mindaugus Batchius and Kevin van Malen. They are effectively asking like what to do with Apple right now in this. So maybe some background, right? So we know that the US government has been, cracking down big tech lately. It's we have seen the hearings sometimes also towards Meta, TikTok, whatever it is. Yeah. And in this case, the Department of Justice, I believe, they joined 16 states and the District of Columbia to file a significant challenge to the reach and influence of Apple. Effectively, they feel like they argue that Apple keeps customers reliant on their iPhones and provide high switching costs and their to competing device, and therefore creating a monopoly, which triggers the antitrust laws, which is very interesting. We
Yeah.
know Europe has been already on their back for quite some time. In the US, usually this takes a little bit longer. The first response often from the US is like, these Europeans are trying to steal our gold. They're just not innovative. Yeah, but in these cases, I think just there's more consumer protection typically in the European Union. On the other end, if the US finds you, you know that you're in trouble. If the EU finds you, it's like a parking bill. Yeah, you throw it away, you pay it, and you move on.
Yeah.
So look, I'm an Apple shareholder. I own it already for a very long time. It went 4 or 5 fold. For me, this is a business that you don't trade, but you own it. I can't imagine Apple really hurting from this. Let's assume they would need to maybe do a spin-off or something. Yes, it can trigger their revenue, but just look at the brand stickiness. I mean, my son, yeah, an early teenager, is only talking about iPhone. It's for him the gold standard. Yeah, he feels having a Samsung is like a budget phone. He feels ashamed for it. Now, I tell you, that means that this generation of early teenagers will be really with iPhone later on. It has such a brand appeal. So if you then look at what they're selling, the margins that they make, let it be a little bit less margin. Yes, it may decline a bit the share price, but I look at it from a very long point of view, and this doesn't scare me. This doesn't scare me.
I agree with you on the next generation. Even the generation above your son, they're all about iPhones. We're the same in work. I can see with the younger engineers that are coming in behind me. They all seem to have iPhones. They make fun of me with my new Samsung 23, which is quite interesting, the dynamic. But the question I would have, and I think to myself, is how long can these big tech companies take on the government and keep winning? Because the government have a being up on it. They want to take these apart bit by bit. We can see this happening across the world. So, I mean, you'd have to think eventually they can't keep taking on governments and winning.
Yeah, but then what I expect is that they will start spinning off the businesses. We'll get shares in those, and you get the situation of where you have Apfi and Abbott, where you have, how is it, Altria and Philip Morris. They can still on their own generate a lot of shareholder wealth. Yeah, so I mean that's really a long way from where it is now. If anything, I expect it to settle somewhere then, and then maybe some agreements that will improve it. For instance, decoupling, I don't know, decoupling the App Store or something like that from iOS. That I don't know, certain things can be done elsewhere. I don't even if that's logical from an IT point of view, but I can imagine some things like that to happen, or that, for instance, your Apple account should be able to work on a Samsung, and that an Apple device should be allowing a Google ID or a Google account. I don't know, how that could all look like, what they are exactly looking into. But I mean, I can imagine a little bit more interoperability with other providers. I think the big issue that I've always been concerned about is the App Store margin that they take, the 30%, and punishing companies that do their own direct payment. For me, that felt always like this is something that can get them into trouble. But then if you look at the revenue and the profit, yes, the software business has been growing over time, but it's still the Apple devices that bring in the most. Yeah. So yeah,
Yeah.
let's
So,
see. It can temper their growth profile in the end, but for now, let's see how it plays out. I'm not too worried about it.
yeah. So it could present some good buying opportunities for investors. Who knows? Nike are in the news because they now sponsor the German football team. And that, to me, that's big news because Adidas, or Adidas, whatever you want to call them, are a German company. They've been sponsoring the German football team for 70 years. You have this American company coming in and swooping right in under them.
Yeah.
Feels to me like a kick in the teeth to Adidas.
Yeah, and Adidas was quite surprised. But what I heard also somewhere is that I believe Nike is offering 100 million, and I think Adidas was only offering 50 million. So they definitely outbid them. Um, I mean, this is kind of sad. And of course, this is a capitalistic system. Yeah, but we are still a little bit patriotic, right? And
Yes.
I can't see Adidas disconnected from from the German national team. I just can't see it. The three stripes are iconic. Yeah, iconic. Yeah. So to have Nike there now with the swoosh, it feels so alien to me. It feels so alien. I don't know if Nike will get everything out of it or that they just think like 100 million is worth a price to pay to offend our biggest competitor.
Yeah, I mean, look, I think it's wrong. I don't like it at all. As you said, Adidas is German. The German national team should be wearing it. I know it comes down to money, as you say, and 100 million is an awful lot to pay for an international football team. I don't know how they make that money back. I really don't.
So if
But
you would be the chairman of the German Football Association,
I mean, look,
would you take the deal if it
if
twice as much?
if I was German, probably. See, it's hard to say no. I have to be
You ever think
realistic.
about what you
It's
could all do? You can invest it back in youth football, women's
that's what
football,
that's what I mean. It's too hard to
and
say no. It's
it
the
doesn't
money.
matter. You don't need to be a bean counter then. You can lose some money here and there. So as a chairman, you can flush the
Money
money
talks.
around through the system.
Money talks. So it would be hard to say no. Obviously, it would be hard to say no.
I think it's just a giant middle finger from Nike. I don't think they're looking here for profit. They just want to kill Adidas. And I think they want to hurt them in where it hurts them the most. And that's why I think they did this deal. Not for the profit, purely for that. Yeah, if you read the book Shoe Dog, their mission when they founded the company was to beat Adidas. That was their mission. Yeah,
Yeah.
not like making the best shoes in the world. No, beat Adidas.
It's like when Alex Ferguson took over Manchester United and wanted to take down Liverpool. It's the same sort of
Yeah,
vibe.
yeah, yeah, exactly. I think it works like that. It's from one side is also entertainment, right?
Yeah. Okay, let's finish on some positive news. And our last news item is Sam Bankman Fried is going to jail for 25 years. It's the first time we are seeing bankers going to jail over committing such fraud.
Well, of course, we had some famous bankers in the past, right? Around 2008 as well. What was this guy again from New York with his hedge fund? The iconic one that was almost sentenced for life. What was the name again? But this is the first time in the crypto world, let's say, where a big guy goes in, and we were making fun a little bit, like it was already in the sky. Yeah, I mean the guy is called Sam, Uncle Sam, Bankman, the man from the bank, got fried. Yeah, I mean if you read the name, I mean I would make this name up as a scammer. Yeah, there's this guy like, and this guy is probably born into this name, and you see this often, right? The association with names and their profession. I think the famous Wall Street guy called Art Cashin. Yeah, the art of cashing. Yeah, so this one's called Sam Bankman. Bankers are wankers. Yeah, he should have been called Sam Bankman got fried. Yeah, that would have been the right way. So it was all up in the air. So everyone who got scammed, they should just read. It's the same like you call being your name, right? Yeah, no, yeah. So, but look, I think it's if you think about 25 years, I mean, this guy is a young lad, right, under the
Yeah.
30s. I feel for him to some extent because 25 years being in jail. But on the other hand, he needs to live up to his consequences because we know that there are people that made suicide after this because they lost all their wealth, couldn't see their relatives in their eyes, and they killed themselves. Yeah. So I think this is a very, very serious case. Dreams have been destroyed because of what he did and how he squandered around. Yeah, it has consequences. So he needs to live up to it. I hope he gets a better person out of it and that he can give something back to society later. 25 years is a long, long time for someone.
Yeah.
But yeah, it feels kind of justice for me if you think about it.
Yeah, and I mean it's also going to be used as like a base case. So anyone who's thinking about scamming or fraud in the crypto space would probably take a step back now and go, okay, if I get caught, this is what I'm facing with. So if it
Yeah.
prevents even one or two people from going down that road, it'll be worth it. But
Yeah.
yeah, I feel from a little bit, 25 years is a long time, but people, as you said, have lost their life over this. And I mean, what? They'll never get that back. So.
Exactly.
Okay, dividend news. Dividend news. We don't have much.
Yes. Well, we
We
have
don't
two
have,
hikes. One is from JP Morgan. They hiked their dividend by 9.5% to $1.15 per share quarterly.
yeah,
I mean, people that invested in JP Morgan, they have done pretty well lately. I think if I really think about the American banks, then JP Morgan somehow stands out as an investment bank. Also, how the CEO has its influence in Wall Street and politics. It's really one of the ones that I would probably feel most comfortable with JP Morgan. So that's one. But if we go then to the insurance industry, small cap Chesnara hiked the dividend by about 3.5% here as well to almost 24 pence per share on an annual basis. It's a small position that I have. Well, actually, not too small. It's not in my lowest, but big disclaimer here. Yeah, liquidity issues. If you want to trade in this stock and something happens, you may not be able to easily get out. Yeah, that's always the disclaimer with these small caps. But yeah, 3.5% hike again. I've got now more than 10% yield on cost. So every time when it hikes the dividend by 2 to 4%, it's nicely compounding. And you know, if you compare that to 1.5 to 2% there, how much time that will take to there, you don't get a lot of capital appreciation. Generally, the insurance industry is already suffering from very low multiples. So I didn't make any capital gains on there, but over those 2-3 years, the 10% yield coming in, I mean, it's like a bond to the 10% yield for me.
yeah,
So really happy with that one, honestly. Sometimes you need to appreciate those things, right? People talk always about the big guys, the Home Depots of this world, but then I really get a lot of joy out of these kinds of stocks hiking the dividend while offering already, like, I think today it is a 9% yield or something like that. Yeah, and a pretty safe dividend, in my opinion.
yeah, yeah. It's nice. High starting yield, a little bit of growth, 3% growth from a high yielding company like that is
Yeah,
sometimes
as an
awesome.
income investor, of course, it comes with risk, all these kinds of things. It's a hard business to analyze. Yeah, I would really say, like, if you get interested in this, read a report and then judge again. It's really hard to analyze this. So, and you can't borrow conviction, what we always say. Yeah. Um, but I mean, how many years would it take to get to this 10% yield for other stocks that have like 3% yield and 6% growth? This one now is a 9% yield and let's say 3% growth on average. It's already your Chowder rule of 12.
Yeah,
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 but of course these stocks are hardly known, and but it's a dividend grower, right? 20 years or so of consecutive dividend growth.
yeah, yeah. As you said, small cap though, so has its risks, but
Yeah, think twice. Think twice.
think twice. Okay, we'll move on to our main topic, and it's all centered around that saying. You know, your portfolio is like a bar of soap. The more you mess with it, the smaller it is likely to get. And we get questions from time to time about selling, how we sell, why we sell, or how we maintain our portfolio. So I think that's what we'll speak a little bit about today.
Yeah, definitely. I think it's a really interesting one because also spring cleaning is around the corner for me. And I also sometimes get some questions about it. And it's kind of to the point of the quote that you just made from the bar of soap, right? Ideally, we don't touch our portfolio at all. Yeah. On the other end, I've got my learnings. So there are actually three topics that I would like to separate my maintenance philosophy in. The first one is just I sell at any time when there's a dividend cut. Not directly, because I do my due diligence. We mentioned often enough here that we didn't sell Shell at the time in 2020 when they cut the dividend. But I
Yep.
would say 80% of the time I sell. Yeah. So I said so that is really I think an important one for me, and I guess is the latest one. It cut the dividend by 42% or something like that. I feel like okay, I can't trust the company. They didn't keep to their own words and their own plan that they laid out for us until the end of 2025. So get rid of it, cut it off, cut it quickly, and at least you don't get reminded about it. Yeah, it hurts, but this is what it is.
Yep.
Then the second one, when it comes to portfolio maintenance, is my spring cleaning each year. Now, what does this really mean for me? I go through my entire portfolio and I really reassess all my stocks that I have doubt about. So for every stock, I capture what my investment thesis is. Yeah, so there are stocks. I give you an example. Viatris.
Yes.
I bought Viatris for the attractive combination of dividend yield, dividend growth. What happened in the meantime? They sold the biosimilars business. It's really hard for me now to judge what the remaining business is there. It is now more of a trust in management because what they take the approach now is portfolio management. Will they be able to buy small companies and build a new pipeline? Yeah.
Yep.
I don't know. Yeah, and at the same time, they froze the dividend and rather focus on paying down debt, which I appreciate that they are doing that because they need it with the cash flow, and prefer buybacks because the stock is trading at a multiple of 4 or 5. Yeah, so it makes me question like, okay, what am I owning now? Am I owning still dividend growth stock or am I owning mostly a turnaround now? And I got more and more allergic to turnarounds. So Viatris, as an example, is on my list to reevaluate. Maybe there's a better investment there at a similar yield with a better dividend growth profile and less risk. So that's kind of the stuff that I will be looking at. It's not like an immediate sell, but like really thinking a bit deeper, like why do I have this in my portfolio? Why did I have it in the first place? And do I want to continue having it? That's really what spring cleaning is. Why in the spring? Because in the third and fourth quarter in the year, I'm mostly focused on hitting my goals. The first quarter of the year, I'm focused on the annual reports. So the second quarter for me is usually the time that I get the time to sit down a little bit and do this kind of evaluation. So for each of the stocks that I have doubt about, I revisit my investment thesis. I do the necessary research. I read the last statements and the CEO comments because sometimes you don't spend with all the violence of all the annual reports and updates in the first quarter. You don't get to really deeply understand everything. So this is the time that I can spend a bit more about it. Hey, and if I lost my conviction, I just consider selling them. So often you see with me the most transactions in April, May happening for that reason. And the money received will be redeployed in my other stocks that are at that moment, on my radar, let's say on my watch list. So that's the important one by spring cleaning. And usually it leads to 2 or 3 stocks per year. Yeah, I've got a portfolio of 45, 50 stocks. So I'm talking here about, let's say, between 0 and 5 stocks that I may consider selling because of this. Because sometimes we talk about the stock, we write about the stock. I make an initiating position as well. I put, let's say, €1,000 in it for my portfolio. That's a very small starting position at this moment in time. And then I noticed that during a year or 2 years, I didn't do anything else with it. Why not? Is then the question. Well, actually, it doesn't serve a purpose in my portfolio. So then I could also sell it again because I don't need all this like fragmented stuff in my portfolio here because it just pollutes my time spent that I have for maintaining my portfolio. Now, last but not least, Something else that I do is tax harvesting. So I live in Poland, and in Poland, you have capital gains tax.
Yeah.
So for me, I can often sell some shares that I'm at a loss at in December to, for instance, compensate for the stocks that I had to sell that made a little profit. Where do I get my profit from? Either from option selling or from other stocks that I sold that where I lost my conviction but still made a profit, right? Because during spring cleaning, most of my stocks I get a small profit from after 1 year. It doesn't happen too often that my stocks go down like that from those investments.
Yeah.
So tax harvesting is a nice way of doing that. For instance, this year I made doing that with some buyer shares that I still have in my portfolio. Just get rid of them, but get the benefit of a 90% tax benefit. I know that this doesn't work like that in maybe some countries like Netherlands where they more have kind of a wealth tax as such. But in a country like Poland, tax harvesting is really an option to me. So, and then and sometimes I can even buy back the shares later. I did that one time with Alibaba. I sold the ADR shares from the US because I was still wanting them in my portfolio, and I bought them 1 or 2 months later back on the Hong Kong stock exchange and mitigated also the risk of ownership there.
Yeah, yeah. It was a question I was going to ask you. Would you consider buying back stocks, or is there a time period that you have that you can buy back?
Yeah, I'm not entirely. I need to look up my notes about it. I have it written somewhere, but generally speaking, yeah. For instance, you could argue that maybe something. Let's say you bought a lot of Texas instruments at $170, would drop to $130. You still would want them in the long term. Yeah, in this case, you could sell them and then buy them back and just make use of the temporary gain you get out of this from a tax point of view to avoid the tax bill.
Yeah, yeah. It makes sense in some cases, but it's hard to calculate that on your own. Sometimes, I mean, you probably have an Excel sheet. You're financially literate, but it is hard to judge how that impacts. So sometimes you need professional help for that.
Yeah, yeah, of course. I mean, but hey, listen up. If you can't calculate your wins and your losses during the year, then maybe it's also a question like just why are you investing in single stocks at all? Yeah, because if once you go into in the individual stocks, it's not like an ETF. You need to be a little bit like analytical to understand the business. And then I may also fairly assume that people know how to calculate pluses and minuses in their sheets and understand how much they made in profit in a year and how much they sold. In the end, they need to also fill in the tax form correctly. So if you do it anyway, do your pre-calculations in December and don't wait till Q1 next year because you may benefit from tax harvesting.
So only other question I have, and I'm curious about this, is spring cleaning is coming up, I assume, next week or the week after for you. It's the start of spring.
Yeah, that will be more in May probably because in April I'm limited in time.
Who's on your list?
Well, definitely BASF, Bayer. So two Germans, Viatris is on my list. Those three come quickly to my mind. I still have some 3M in my portfolio. Not a lot, almost nothing anymore, but I may close that position entirely. So those are Unilever is a big question mark for me. We alluded to that a little bit easier. Haven't made up my mind there on this. So yeah, there are several stocks that I have on my mind. Unilever would be a big one for me, really tough one because I think it's in my top 10, sometimes even number 5. So I really, really need to think about that. But if I do anything, I don't see myself selling entirely out of Unilever at once. I may do something like that I did with 3M, like slowly lowering my position. For instance, Unilever was always a tier 1 stock for me or something like that. So maybe I downgraded to tier 3, make the equivalent sales to that, let it be there and redeploy the money in a more higher conviction stock.
Yeah, that's it. Unilever is going to be about conviction. What's your conviction on them going forward?
I don't know it yet. I need to really make up my mind there.
Yeah, it's quite interesting when I hear you talk about it. You sit down yearly, you do the spring cleaning. It's not something I do, but actually going back to that first quote that I said, your portfolio is like a bar of soap. I'm a lot more active than I thought I would be when it comes to buying and selling. And I'm just looking at this year alone. I've sold 1, 2, 3, 4, four companies already, and the fifth one will be sold this year, which is Enegas. So it's BASF, Walgreens, Unilever, and CME Group. I've sold them, and Enegas, there's a sell order in for them, so they will be gone this year. So it kind of surprised me because I always say we're buying hold or even buying analyze. I didn't realize that I'd be so active. So for me, I have to take a step back and I have to look at two things. Okay, why am I selling these things? What am I going to learn about them first?
Why did you buy them in the first place?
Exactly. So I have to learn about why I bought them in the first place. So there's definitely some learnings there. I can argue that BASF played out exactly as I had anticipated. They were a high yield play. I intended to own them for a couple of years. They're cyclical, so you kind of anticipate when they're going to go pretty bad. They've already told us heads up next year they're going to cut the dividend. I actually was surprised because I remember they were at €45 maybe 3 or 4 months ago. I had a sell order at €53 and it hit that. I was actually ecstatic. So I've made all my money back in terms of there's no capital gains loss. I bought them at around 51, and then they've paid me dividends for 2 years. So I kind of happy with that decision. Then the ones that stick out more is Walgreens. So what's the mistake? What's the learnings I did there? And when I look back at my notes, it was the first company I analyzed properly from scratch on my own without reading anyone else's or taking anyone else's thoughts into consideration. And I'm looking through what I wrote down, and it feels like that. So you go into a car sale shop and the car manager comes over to you and he's telling you all the good things and you soak it all in, you take it all in and you walk away and you buy the car. It feels like I just took everything management said and wanted it to be as positive as what they were saying. I didn't look at it negatively enough, or I didn't challenge invert. What did you say recently? Invert, always invert.
Yeah.
I didn't do that with Walgreens, and that's probably my biggest learning from that. Unilever did not meet my growth expectations at all. I expected them to grow, but again, I was over-eager, over-believing management, overestimating what their growth would be without actually challenging
It's
them.
an iconic European dividend company. Let's not forget,
Of course, but I'm in this to make money, and I need to.
I know, but I think that aspect mattered also to me. You buy history as well at the same time.
100%. It was my second European company. My first one was Glanbia because it was Irish, so it obviously means a lot to you on that in that sense. And then Enegas management lied to me, so I mean they had it plain black and white. So yeah, again, trust in management. And then CME Group, that was a starter position for me to analyze them further. I'm glad I did because now I do not see where the growth component comes into them, and I was happy enough to sell them. But if you look at my one biggest learning there is to stop trusting management and maybe do a little bit more digging outside of that realm myself and make my own opinion. I think that was my biggest learning from that.
It's funny that you say that because today there was a tweet on the X where someone said like, "What's your biggest mistake?" or something like that. And the first thing that came to my mind is trusting the words of a CEO more than what more than the story the three financial statements tell to me.
Oh, did someone say that?
Yeah, I said that. That was my response to the biggest mistake. I mean, if you ask me tomorrow another one about the biggest mistake, maybe something else comes to my mind.
Yeah.
But this came to my mind first, like trusting the words of the CEO while the statements tell you a totally different story.
Yeah, I think what happens is that you sit down and you start to read the financial statements. You read maybe 3 or 4 of them, and what's the first thing you read is the CEO statement, and you're reading that, and you maybe just get sucked up into it, and then you already have a preconceived idea in your head about where they think the growth is. I'm not an expert in Walgreens in that area, so I'm probably relying. Like if it's an engineering company, I can look more specifically automation or electrical. I can look more objectively because it's my area of competence. When it's not my area of competence, I'm probably leaning a little bit too much on what the CEO does. I probably need to reach out to people in that industry and get their sense and get their feeling, because normally people within the industry have a good sense of what companies in that industry are like, not even from an investment point of view, but even operationally, how their reputation is, what the management is like, and so on. So it's an interesting learning for me to actually sit back and do that. So I have to try and take that on board and see how I apply that. In terms of tax harvesting, I've never actually sat down intentionally to do it. I've always ended up doing it anyway. And
So are you the guy that can't calculate?
no, I can calculate. I also have an accountant, but what I do know is even if you have an accountant, you still they make mistakes. You still have to double check because it's your ass on the line. But no, I can definitely. One and one is three, right? I can definitely calculate. But I haven't sat down naturally to do it. It's just happened organically because of the types of companies I've sold. Walgreens, for example, was a big one. I've lost capital gains, lost on Unilever, made up in some dividends. So it's always happened naturally. But I think my end goal is to be a little less active than what I am. I don't want to be selling as much as I am. So for me, that means improving my analysis and the companies that I'm choosing and picking on my. And that's
Yeah, I have the same. I have the same. Although with the starting positions, I don't mind that. For me, that's not the bar of soap analogy. Yeah,
no, no,
but the ones where I really started building up positions. But honestly, I hardly ever sell them. I mean, it's usually the dividend cut as an example, but not because I lost conviction. That hardly ever happens nowadays. In the beginning, it was different to your point, but when you go to the journey, you kind of refine your strategy all the time. Yeah, and unfortunately, you can read as many books as you want from the greatest investors. I don't know a lot of people that were able to straight away copy that and be successful, because most of the people we talk to, they all say you have to make your fair share of mistakes. Even reading dozens of books, you still need to do that because there's no price you can pay to get that learning.
yeah. Do you ever hear the saying, it's the same but different? That's
Uh,
exactly what it is. We
yeah,
all do the same thing, but we do it differently to try and get
yeah,
the same result and emotionally. But yeah, look, Walgreens and Unilever were two big positions for me in terms of my portfolio. They were big positions, and I would argue Walgreens was the biggest mistake of the two. And there was a lot to learn from Walgreens. And actually, like Unilever just flattened, whereas Walgreens tanked. So that's the one I need to focus on.
yeah, definitely, definitely. And yeah, Unilever might not be. I mean, it's now still a good time, right? Because Unilever is what is it, 3.7% dividend yield. So there's still like enough alternatives there to redeploy the money. Yeah. So you did it probably at the right time still.
Yeah, I mean, I closed them close to what I bought them at. I had them for 4 or 5 years, so made some nice dividends. I am not going to be done with them forever. I would say if I do manage to see them turning around and I can see them starting to prioritize investors and we start to see that shareholder value, of course, I would love to own them again.
Yeah.
It's one that I will keep watching closely. Walgreens is dead to me forever, but I mean, I will stick close to Unilever. So I'm rooting for them. I actually, like as you said, it's
Yeah.
European, it's iconic. Most of my brands, I open up my pantry.
Yeah.
It's all Unilever. So I'm rooting for these guys.
Yeah. Unilever produces soap, right?
Yes, yes, and pretty big bars too.
Exactly. Exactly. So look, I think it's very nice to discuss this a little bit. We have a slightly different approach here because I kind of do the spring cleaning very strategically each year to keep my
Yeah,
portfolio. So one of the learnings I had is like you need to be proactive on this. What I mean is like with Walgreens and such, you're in a reactive mode. Yeah,
yes,
here I should have sold buyer much earlier as example as well, but I already discounted it, written it off, and everything. But still, you see what can happen to the share price. Yeah, but my learning is that we should be more proactive on this because usually the clues are already there. You may have already lost the conviction a long time ago, but you just never spent the time to really sit down and act on it. Yeah,
yeah,
and then what I notice is like when things screw up on my portfolio, it's not like I didn't see it coming. I saw it coming. That's why I started implementing spring cleaning to be proactive on this because when you're proactive, you usually can get away with it without too many capital loss, yeah,
yeah.
here, and still maybe benefit from some capital gains. So that's kind of why I'm doing spring cleaning here to just be proactive. But of course, you need to watch out because, yeah, it can be that you make the wrong decisions. Yeah, there are enough companies and examples that went through a tough time, but committed to the dividend and then went up
Yeah.
again, right?
Yeah.
So, but I would say that the companies that I'm looking like Unilever, yes, they were so far committed to the dividend, but they sneakily changed the policy with a few words, flat dividends for 3 years now. Viatris the same. So the growth story is not demonstrated there already, right? So that's why it's also on my radar. If they would have continued growing and also the EPS would have been growing, they would have never been on my radar.
Exactly. Exactly. Okay, good. Nice one to talk through. Maybe it's time for some listeners' questions now. And Pete Lee is the first question, and he's asking, is this a good or a bad idea? So when he is valuing a company on the guy wrote that pays a dividend, so I assume any company, he looks at the analyst vision, and if there's a lot of green numbers, I buy. Is that a good idea?
It is hard to answer that, Pete, because are you also selling then when it has a lot of red numbers there? Um, I think it comes here to the good old thing that we say is like you can't borrow conviction. Are you going to blame the analysts later when it goes wrong? We know that if you look at the historical charts, that the analysts are always more optimistic than what reality brings. Yeah, and then they adjust later to reflect the current share price. That is just known. Yeah. So analysts are typically upgrading if the share price went up and downgrading if the share price went down, because it triggers a sentiment, and also that it shouldn't look like fools, right? If they are saying $100 for the shares, while it went from 90 to 50, they usually reduce them to 60 or something like that. That's kind of the psychological behavior we see. So for me, I personally don't follow that strategy, but I wouldn't say that you can't make money with it. I haven't studied this enough. Maybe you can make money with it. I don't know.
Yeah, I mean, I'm going to make an assumption that Pete has done all his due diligence on a company because he's now at a stage where he's valuing the company and he's not looking at the analyst to value the company. He's made a valuation. I assume he thinks it's undervalued by his metrics, and he's looking for confirmation. I think that's all it is. I think you've already have your mind made up, but you're looking for that little bit of extra confirmation. And I think it all comes back to conviction. Do you have enough conviction in your own strengths to analyze a company? And maybe you're on the fence
Yeah.
and you just need that little bit of a push. But yeah, I don't pay too much attention to what analysts say. As you said, most of them are insiders. They're paid off. They can't say anything bad, or they won't get any good information. So it's hard. You never see.
But they're also very good analysts. Yeah, that's the issue. If you read sometimes the reports of some analysts, they are of such high quality. We love, for instance, the Moody's reports around the credit rating and how
Yes.
they are written. Yeah, they're very well written. So the issue is typically with incentives that analysts have, which kind of can rig the game. But there are also really good analysts. Yeah. But for me, the aggregated data that the hero shows about the green numbers doesn't tell that story. Then you need to have a few analysts that you know that have a good track record, that you trust deeply, because not every analyst is fooling, yeah, or under pressure. There are also a lot of analysts that are independent thinkers. They do their homework, will be contrarian if needed. Yeah, and I think spotting those, I usually value their opinions. Yeah.
Yeah, finding them is like finding a needle in a haystack. Richard has asked us about a book, The Ownership Dividend, The Coming Paradigm Shift in the US Stock Market. It is by Daniel Paris, if anybody's looking for it. Have you ever read this type of book?
Um, no, actually, I haven't. I haven't read it, and it sounds interesting. At a certain moment, you read so many dividend books that it's kind of all the time a bit similar. But if this one is really different, it could be an interesting read. I can tell you because he's also mentioned like it would be cool to have a book club segment in the podcast. So I tell you what I bought today. I bought the book The Chip Wars because I've got a bit of Intel. And ASML, and I'm intrigued by this industry. So, and I know the book was released last summer, but I bought it now. I really want to read it. It's probably almost 500 pages, so it will take a time to get through it. Maybe during the Easter break. But yeah, so book club, I like it. but it requires a lot of reading, and I don't know if we have the time for that to prepare for that. Yeah.
Yeah, a book club would be cool. And look, we have a Facebook group, and if there's people interested in that, want to share their ideas, why not? Why not?
Yeah, we can do this on Facebook. So maybe Richard, be our guest and give us a little bit of a brief summary of the book and what you took away from it. It would be really interesting. Yeah, I think also for us and for others.
Awesome. Andrew has asked us a question, and I was reading it. That's why I did a little chuckle. He said, after you gave Reckitt Benckiser Group PLC the kiss of death on your last podcast, do you think it is now investable? If you take a brief look, it shows that it's potentially investable. Perhaps it could be a candidate for a stock card deep dive for your subscribers. Yeah, look, we spoke about them on the last podcast. They have a lot of high brands, a lot of high quality. I don't know what happened since we last spoke about them. They must have tanked in price. I didn't check, but look, I do think it is investable. It would be at the right price. The problem for me is similar to Unilever, and it is in terms of growth. How do they continue to grow that company? What does it look like in 5 or 6 years? I already know that their brands are in a lot of households in the US and Europe. How do they increase that? Would be my main question. But look, it all comes down to valuation and the price and what we see. So yeah, I think you're right. It definitely does deserve a stock card and maybe even a deep dive, because it is a rather interesting company. So consider it to be a stock card at least at a minimum, and maybe we might do a deep dive in the future.
Yeah, and I'm looking at the share price here, and in February it was trading around, I guess, 58 pounds, and now it's trading around 45 pounds. So that's quite a significant decline of 15 to 20%, right? So yeah, let's take it up and do some analysis around this one.
Kieran has asked us, I know we often give companies a red flag mark when they cut earnings, but would you still do that for a company that was fundamentally impacted by COVID? He's thinking about Win, which I think is the hotel group, WYNN, is his obvious example because they had to close their businesses during COVID. I mean, I
think
that's
this
fair.
deserves a special case. Yeah, what it mostly tells you is their I said their resilience during economic stress, a certain shock to the market. That's what it tells you. I would say we gave Shell a pass. Yeah, we gave some insurance companies a pass. They paid their dividends still later. So it's really personal. I would say, because I always look at like this is my income. If a shock to the system happens, I will depend most likely even more on my income. So if I've got too many of those stocks in there, I would not be happy. But I think if you have 1 or 2 in your portfolio out of 40, it should be fine, because the other dividend stocks should cover the loss in dividend income in that case here. So that's a question: is it then enough of a stable business? Yeah, in this case, and it's also a question: how often do you think that something like COVID happens, that there is a global lockdown? These are the questions. I expect it not to happen too often. Yeah, so, but I think these are personal questions that you need to answer. It's kind of your own risk tolerance and how much you want to punish for companies for that from your portfolio point of view.
Yeah, look, it always depends on the type of company. You look at, I just spoke of Reckitt Benckiser just a moment ago. If that type of company had earnings drop during COVID, I'd be worried, because they were all about hygiene. And actually it turned out that they did pretty well during COVID. So look, it depends on the companies. You're looking at a hotel business like Win. It's obvious that were not going to make money during COVID. It probably made sense that they had to close their business. So yes, I'd give them a
Yeah, but
pass.
look at
on that.
Starbucks. Starbucks made a loss, I believe, during 2020 because they invested a lot in the protection and safety of their customers, of their employees.
The
But they
known
continued
struggle.
paying a dividend because they could absorb. They could absorb it in their balance sheet. Yeah. So here again, if you have such a company, maybe that's the answer. Take them with the strongest balance sheets, and if they are already loaded up to debt, you will be impacted quite severely, quite quickly. Think about Pepsi. Pepsi has a lot of debt. Yeah, high payout ratio. If anything happens, and this is the thing, you usually can't imagine it, but if anything happens to Pepsi's ability to sell cans of Cokes and snacks, yeah, they will have to cut the dividend almost straight away.
Yeah, yeah. I agree. I agree with you. Adrian has said he has a baby coming up, so congratulations to you and your wife.
And
and he
that's
says
why Reckitt is down.
and he said his wife plans to put a small amount monthly income into a new brokerage account for the kid. She asked for a few ETFs to use. What are some no-brainer ETFs for her with a good dividend growth profile?
None. Not in the EU. If you want to have the UCITS versions, which most of us only have access to. I know there are some workarounds. I would not recommend them if you are not specialized in that. So there is none. If there is anything, you can look at those FUSD, I think it's called. It's the Dividend Aristocrats ETF, but just expect a 1 point something percent yield. Those will give you some decent dividend growth. But if you're looking also for a 2 or 3% yield, including that, then they don't exist in Europe. We don't have something like Schwab.
Yeah, the question I'd ask is why limit yourself to dividend growth profile ETFs for a newborn baby? Why not go for an all world ETF or something like that?
Yeah.
You don't need the income. It's for your newborn. So I'm going to assume they won't need it for at least 18 years, maybe 21 years.
Yeah.
I would not limit yourself to a dividend growth portfolio or dividend growth ETF. I would look at the actual standard ETFs and stick with those.
Yeah, and just make a bet on, okay, will the American stock market be better off 20 years from now compared to where it is today? And then if so, if the answer to your question is positive, put some money in there, also taking currency development into consideration.
Yeah, I mean,
think about the European ETF, or think about even a theme-based ETF, maybe technology or whatever you feel where the needs are in the upcoming 20 years. Yeah.
I would definitely put the bulk in an all world index, but I would look at maybe having a percentage in emerging markets. I would also have a percentage in technology would definitely be there. And actually, if I think
about
about
emerging markets, actually, I think over the next 20 years, I expect more geopolitical tensions.
Yeah,
so, but again, these are the questions you need to ask yourself.
Yeah.
But I agree with all world index is probably the most neutral one to choose.
Like if you had 50% in that and 10% in 5 others, I mean,
but if you don't care so much about the dividend yield, I would still say something like the ticker FUSD. I believe it's that one, if I remember correctly, which is Dividend Aristocrats, because we know that Dividend Aristocrats generally outperform the broader market. So if you want to have a combination of some starting yield plus capital appreciation, that could be a good one, I think. But if you feel like you want to have a decent yield, like let's say more than 2.5%, then forget about it. Most of them, you can't count on dividend growth.
I hope that answers your question anyway. So Thomas has asked us a question, and I think he wrote this to you, European DJ. Is it about his portfolio?
Yeah, it's about so we were just talking about ETF. So Thomas says that UPS is now the biggest one position in the Schwab dividend growth ETF, so SCHD, the popular one. And he says he has been thinking for this company for a long time, but it always felt too expensive. On the other end, they offer now a decent dividend yield and growth. Is it sustainable also in view of their debt? I mean, I have looked at UPS so often, specifically when it was trading around $90, $100, and I always shied away because of the balance sheet. I don't like their balance sheet. It's a low margin business. It is the best business because if you compare it with FedEx struggles a lot with their free cash flow. UPS is better from that point of view. But the pension obligations always scared me away with UPS. So have a look at that one, Thomas. You need to feel comfortable with that. And what surprised me the most, and I really was flabbergasted with that, is that UPS then at a certain moment hiked the dividend by, what was it, 50% or something like that, or 50 cents, like really, really huge. I didn't understand that because I really felt like the company is bringing a lot of dividend hikes forwards, and it will bite them later. Yeah, on the back of a lot of shipping happening after COVID. So I'm not surprised that it's trading now again around 140s, I believe, at the time of writing when Thomas sent this. I'm just not a big fan of it. I think these are low margin businesses. It requires a lot of capital investment and maintenance because it's the last mile delivery and everything. It's very, very complex. But this company has been doing it for decades, right? So it has proven itself. But so far in all those years, I've looked every year 1 or 2 times at it, and every time I feel like, nah, yeah, there's something that stops me, and I don't have an issue anymore with FOMO. Yeah, I consider joy of missing out. I don't need to own it. So that's my humble opinion. That is number one. It's actually number two in the SCHD, if I remember correctly. But also I think Pfizer is in there, if I'm not mistaken, and such. So these are not the strongest companies in my opinion. So it's also interesting what SCHD will do from a performance point of view over the next year. Yeah, but there may be maybe two options. Either they outperform again because those companies they had a lot of multiple compression, and now it will get released a little bit.
Yeah.
But I'm not a big fan of UPS. Bottom line, I love that they are one of the best delivery companies in the world. I like that. So business wise, they do something really well. But as a stock, I don't like it.
Yeah, I don't want to own it as a stock, and I always remember pensions. Every time someone says UPS, I have pensions in my head because you've spoke to me about that before. But I do want to work for the company. I mean, I'm looking at the page here, and it says UPS delivery drivers receive an average total compensation package of 145,000 per year. You sign me up.
Just for driving around and having the radio on all day.
I mean, it sounds incredible, doesn't it? 145,000 to
Wow.
deliver packages.
Wow.
So
Wow.
maybe that's where our dividend money is going.
Or maybe they will just automate all the people and then you don't need the pensions anymore. But I think these pensions are still future obligations to what retirees put aside. Yeah, which company was it the other day? They maybe it was UPS or it was IBM. I think it was IBM. Yeah, IBM. They did like several billions of selling their pension obligation. So they had a one-off income impact, EPS impact, but they sold it to an insurance company so that they could take it off the books, which was also maybe that's something that UPS could also consider if they haven't done so yet. I must say, we are talking about pensions here, but I haven't opened the balance sheet for a year. Yeah, so maybe they did something already with it. I don't know.
Yeah. Okay, European DJI. Niak was asking if you could give your opinion on Dino Polska, the NP.PA.
Yeah. So you know how much I got this question. Yeah. So it's Nick now, maybe we listed here, but left and right, I got approached by this because a very big financial influencer called Compounding Quality. He wrote about this extensively, that he added it to his portfolio and everything. And I'm based in Poland, so people are saying like, "Why are you not buying Dino Polska?" Yeah. Now, I tell you a bit of a story about Dino Polska living here, and it's a bearish story. And I'm looking at it from a company point of view, not a stock point of view. If you see these shops, and actually you saw building when you were with me, I pointed you. Look, oh, this is Dino Polska. Yeah,
Yeah.
they are. So this is a supermarket retail chain building shops all around the country in rural areas. Yeah. Typically replacing the mom and pop shops. Yeah. This is a company that, in my opinion, can't compete with the likes of Biedronka and Lidl over here. But I also don't think that is a strategy, because the big ones like Lidl, they aren't there because there's not enough population in those areas. Yeah, so not enough business. Also think about this, it's a big country. So if you need to send your trucks every day to resupply the stores, it comes at a high cost. So generally speaking, I expect Dino Polska to be a lower margin business than the big players in the market. Now, they have been growing very, very, how you say it, admirably over the years because they have been building shops like mushrooms everywhere. And this is also how they've been growing. Their cash flow is continuously being reinvested in new store openings. I believe even this is a founder-led business. I believe he has 51% of the shares. I even believe that the construction company has probably some shares in. So it kind of is going from one pocket to another pocket. So what you're buying here really is the growth story. And this company is an expansion. So I think from a stock point of view, you can earn still a lot of money with it by following this approach. But what I would like to see is like, what are the like-for-like sales in stores that are opened for more than 2 years? Yeah, are they able to do something here? Because typically, when I walk in such a shop, the prices are a bit higher. Yeah, of course, they don't have a lot of competition in those areas. But on the other end, I don't see that this business has a moat, because if you can expand so quickly in those areas, there can be simply just a competitor that does the same, and they take half away the business. Now the question is, once they are there, whether a competitor can do it. Well, Dino Polska is doing this to the mom and pop shops. So if someone has a business model where they are okay with a little bit of lower margin, they can start competing everywhere. So I'm a bit more bearish than the general social media influencers on this one. For me, it's always like, you need to have a good feeling with the company. I would never go to a Dino Polska to buy my shopping there. You go there if it's on the corner to buy your cheese and milk in the morning, and that's about it. Yeah, that's for me the perception I have this. I know there are some Polish listeners there. Maybe they have a different opinion of it. I look at it from that point of view, living close to the big city. I don't like the shops. They are not appealing. I don't see them often too busy where I live. Yeah, I see the Lidls. They are always fully packed. But still, it doesn't mean that with lower foot traffic they can't make money. I think they can't. They of course they can make enough money, but I just don't get this feeling for it. And the issue that I now see with social media is that just such an influencer is making a very bullish case for such a thing, and then people that have never been in Poland start to invest in a retail chain in Poland. Well, for instance, Poland, 80% of people live in rural areas. But if you think about it, there are 5 big cities here where all the money is being made, and outside of it is almost nothing. Yeah, those are villages with a few hundred people, sometimes maybe a few thousand. Yeah, so I don't see a lot of population growth there. So I think like in this growth phase where you're adding a lot of stores, you really increase your revenue and of course your net income. But then what? Once it starts stabilizing there. Yeah, and I don't know when that is. Maybe that's in 10 years. Then shareholders can have 10 years of growth still. But I'm in the end investing for dividends. I want to see a bit of a moat in the company. So here I have definitely again the joy of missing out. And maybe I'll regret myself that everyone told me so like 10 years from now. But I don't get a good feeling with it, and I learned to not consider it. Then, yeah, it's something I wouldn't shop. So why would I own the shares?
Yeah, I get you. And what about the second part of the question then about a Polix index fund as the company? And I speak to you all the time. You're talking about how well economically it's doing over there, and actually how you think it will do in the future. So,
Yeah.
what do you
The
think about it?
country will do economically very well. I think it's positioned really well.
Yeah,
It's still like the nearshoring hub of and logistics hub in Europe because of its positioning. There's a certain hunger in society here to really make a lot out of it, right? In more Western countries, they are talking about working 32 hours, while here 40 hours and more. It's hard working country here. So I'm very bullish on the company on the country economically. The issue is when you look at the stock market in Poland, it's a lot of old industry. Most of it is foreign investment. foreign investment. Yeah, the big tech players like Google, they are here. The big banks, they are here. But the money flows also a bit out of the country. And where it sticks is more like in local businesses a lot. Those are often booming. And yeah, what you see in the major index are some banks, some old, yeah, typically old industry. At the same time, there are also some really good jewels in this in here, but I think you shouldn't go in the index here. So we have been talking about Dino Polska. You could consider that maybe a jewel, yeah, if you're more investing for capital gains. Ambra, which is my favorite dividend grower here. You have, I believe it's live chat. There are people that are very much into CD Projekt. I believe it's this gaming company that created what was the game again? I'm not such a gamer, but also, so there are some, of course, some new businesses as well. But I think in the end, if I would advise in Poland, I would do stock picking and not the general index, because the multiples are compressed. I know, but in my opinion, the multiples are compressed because it's an old business, not a lot of foreign investment. So if it would be a story like CRH that we spoke, yeah, that goes to the American stock exchange and suddenly almost doubles, yeah, if there would be a sudden moment that the Polish stock market gets really attractive by foreigners, but I don't see that happening. It's also not a euro-based stock market, so yeah. Although I live in Poland, I'm very bullish on the country from an economic point of view. I don't see that the index reflects the power of the country, because many people work for corporates that are foreignly owned. Yeah. My humble opinion, but again, I could be totally wrong here. Yeah, I could be totally wrong.
I'm a little bit surprised by that answer, because we speak often, and I know how bullish you are about the country. When I was there, again, I could see it for myself, so I was surprised with that. But yeah, it makes sense what you're saying. Daniel has asked us, what do we think about Garmin? We didn't have the Sunday Runners podcast last week, so maybe as our punishment, we might look at Garmin. Look, Garmin is a company. I think it's because it's from Switzerland. The high tax rate puts me off analyzing these types of companies. When we were in Poland, actually, and myself and Daniel were speaking, and there was a couple of others, we all actually had Garmin watches. I have mine on me, still on me right now. They are quite popular. They are transitioning, I know, into more the fitness and the whole space as well. So I think there's probably some good growth there. Looking at their dividend history, looks strong. Their earning history looks strong. So it does look like a decent company. It just has a 2% dividend yield, which is below my required rate anyway. But then you add the 35% tax rate onto that, and I just find it hard to spend my time analyzing it, knowing that I won't buy it. It'd have to be incredibly cheap, but maybe a 4% yield before I would even look at it. But I can see the value in it. I can see what they're trying to do. It's a good brand. It's got brand power. But then I have to question where the future growth is going to come from. How many more watches can they sell? What other parts of the business are they into? And I know they're not just watches, they're navigation systems. There's lots in it, but I haven't sat down to spend the time to do that. But if I was from Switzerland, I definitely would look at this company. Michael has asked us, or Mikhail has asked us about the 9% drop in a single day of Evolution AB. And I think that was last week, if I remember correctly.
Yeah, it was last week. The stock started recovering already a little bit. There was no news press release, so you really had to go on social media. And there were like 2 stories about it due to a class action lawsuit coming from a gross law firm. But this was kind of old news. But in the end, there was also a short report published. I mean, what I understood from the short report is, again, that they're talking about the business model, Asian companies. I mean, we had Wolf Harcourt on the show here. He explained all of this, so it feels for me like a storm in a glass of water. So I'm not selling my shares. To make it clear, but I understand that some people get nervous about this, because if this keeps popping up, then is this really do you really then have conviction if it makes you nervous? I think your portfolio should consist of stocks where you can sleep well at night. If you get nervous from Evolution dropping 9%, if you get nervous from these stories that you read in short reports, don't own it. it's not worth it, yeah, to lie awake from it. That's my philosophy to investing. I sleep well at night with Evolution. Maybe I've done my homework. Of course, I may be wrong. I calculated into it. I've got a diversified portfolio. So for me, the risk reward is very attractive with Evolution. I can see it growing, the dividend going still for the upcoming years. So I'm kind of bullish on this one.
Cool. The next question then is from Adrian, and he's asked us about our thoughts on Timken Company. Have you ever heard of them?
Skip this one. I have no clue. I put also skip there in the comment.
Sorry. Okay, we'll skip all the ones that good. Okay, I get you.
So we can do Wolters Kluwer, and then ADM and Roche. We can maybe ADM and newsletter for the news section, and Roche maybe a stock card. Yeah.
So we're going to skip these now.
Well, you can say them like from Maciej, because he's our first subscribers. I think we can just say like we will take these on in the newsletter.
Okay.
Yeah.
Okay, and the next question is from Marek, and he has asked us about Wolters Kluwer. The company is still not cheap.
Yeah, it's not cheap, and I'm with you, Marek. I'm very patient already for 5-6 years, so it's still too expensive for me. Yeah, I would love to have it, but not at these prices.
Marek has asked us. He's asked us two questions. The first one is Archer Daniels Midland ADM, and the second one is about Roche. So have you any thoughts on ADM after their earnings?
I haven't studied them, so Maciej is one of our premium subscribers, so I think we can take these two companies just in one of the upcoming newsletters. It will be probably best to do. For me, of course, it's the question about ADM, like after this fraud issue that they had, right, not too long ago. So I'm very interested actually to read what the earnings showed and what the CEO comments are about this one. So let's have a look into that.
Yeah, I do know that they score quite highly on our dividend safety, which is just something that we need to look at, particularly around the fraud case, what that happens, and they increased the dividend straight after that. So yeah, I agree with you. Honestly, I haven't looked at their earnings, but we'll put this in a stock card. The same at Roche. I remember looking at their earnings briefly. I was a little bit underwhelmed, if I remember correctly, but I'll have to revisit that. And again, we'll stick that in some sort of stock card. Lars has asked us about Mandatum as an 8% yield. It's a Finnish asset management company, if I remember correctly. I can't find my mouse, so I can't even change tabs to find it. But I remember looking at these briefly before. I think we were asked about them. And again, look, it was in Finland, so I didn't pay too much attention to them. It is a strong starting yield. I do think that they actually have a good reputation in that company, but I already own T. Rowe Price, already have some Blackstone as well, so I didn't need to spend too much time digging into them. But an 8% yield is hard to turn down, I would say. And then the last question is from Ronnie, and he has asked us our impressions of Kontron AG. That's ticker symbol X or KTN.
Yeah, I looked into this one from Rania, and it's actually quite an interesting company. It's a software services company, specifically operating in the Internet of Things. It has been quite an impressive dividend growth. It was paying like 6 cents in 2014 and €1 last year. In 2022, they paid 35 cents in dividends. Now, I don't know what happened, whether last year was also including a special dividend, because today they announced the earnings and they have a proposed dividend of 50 cents per share. So I don't know what happened last year. I can't find it so quickly if there was a special dividend included into this, because it went from 35 cents to €1 and now to 50 cents. So it sounds like they did something special last year. Maybe they had some, you know what sometimes happens, like a sale or something like that, and that they decided to reward shareholders a little bit more. So it feels a bit awkward, because it suggests now like a dividend cut by 50%, which, if I read the numbers and everything from today, they have been nicely growing. Yeah, so it seems to be a well-growing company. a good dividend profile. So I'm a bit flabbergasted about what happened. I would need to do a little bit more research. But actually, when I was looking into the business before today, I kind of liked what I saw. How they are growing also a bit via acquisition, how they are really operating in the Internet of Things. And we know that this is, from a technology point of view, a very interesting market. And they seem to have a pretty good value proposition there. The numbers support it as well. They have an EBITDA margin last year from 68% compared to 41% last year, which is quite impressive. Yeah, so our EBITDA, I mean EBITDA from 41 to 68, not margin. The margin is 6% last year and almost 9% this year. They have also a really good order book. So I mean, this company seems to do all the right things. So I have a suspicion that this dividend last year was something special to it, and that's why maybe how you say it. Because last year was out of the ordinary from the trend of dividend growth, and this year seems to be normal compared to the historical trend. But very interesting company. So it's ticker symbol KTN. We'll put also in the show notes ticker symbol. And thank you, Rania, for sharing this with me because it triggered my attention. I might need to study it a little bit more. I like these kinds of companies. It's also close to my profession. So yeah, nice one.
Nice. And we have one last question actually, and that is from Jack, and that is your thoughts on United Health, which is ticker symbol UNH.
Yeah, we get this question from time to time. I just don't understand the healthcare insurance landscape in the United States. If the only thing that I hear all the time is that that people are complaining about their healthcare costs, that if they don't have a job, that they can almost go bankrupt because of the healthcare premiums. So, and United Health is one of those that is charging those premiums. So I don't understand this, and that's why I don't invest in it. And this is a funny thing. You hear me this saying now for the fifth or sixth time, like, I don't understand it. I don't get it. I don't have a feeling for it. I just ignore it. Yeah. So I'm not interested. I honestly, tell me, how can you have a business model where you're almost bankrupting people for something fundamental as healthcare? This system in America feels broken. Yeah. And what I know that United Healthcare has a really good dividend growth track record, but how long is this sustainable? We all the time hear from American politics that they want to do something with drug pricing, that they want to do something against this to make the cost of living better for people. I have no clue how this is sustainable in the United States.
Yeah, completely different than over here in Europe. So it's hard for us to get a feel for it, I would say. So there we are, the end of the show. I was actually looking at the clock there around 40 minutes. I thought we were going to have a quick podcast. But for our long runners, this one should be around an hour and a half. So I hope you get through your run. Again, apologies for last week. Thanks to all our listeners for listening this long, and we will see you all next week.
Happy Easter, everyone.
Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.